Welcome back. Our next guest is a legend in the investing world. Jack Bogle founded the Vanguard Group in 1974. He helped turn it into the largest mutual fund company in the world. The Vanguard 500 index that Bogle started and created in 1975 was the first low-cost index mutual fund designed for the average investor. Jack, named by Fortune magazine as one of the 4 giants of the 20th century in the investment industry. He is also the best-selling author of 10 books on his life in investing. He will talk to us about his new book as well. Jack Bogle is with us this weekend, and it is good to see you, Jack. Thanks so much for joining us.
My pleasure, Maria, always.
So much to talk about with you. And let me start off with some news of the week. And, of course, this week we learned that household wealth reached a milestone, Jack, $100 trillion. Americans' wealth surpassed the $100 trillion mark for the first time early this year, which is an incredible number. And, of course, that has to do with stock investing. It also has to do with the price of their homes. Jack Bogle, you are the pioneer in this business. What has changed since you started Vanguard?
Oh, I guess I'd start by saying everything has changed, Maria. One, the mutual fund industry is a totally different business. It's now probably 70% of the cash flow, sometimes 100% of the cash flow is going into index funds, which didn't even exist when I came in, when I started Vanguard all those years ago. And indexing is up to, I think, around 45% of equity mutual fund assets. So it's been a revolution, indexing has, and it's changed the nature of how people look at investing. And most important of all, Maria, it's made people start to think about cost. Cost is everything in this business. Because when you think about it, where are returns generated for we investors? They're generated by corporate America. They earn money, they pay dividends, they reinvest the remainder in the business, and that's where value is created. The financial markets are the way we access that value. But the financial markets don't give us all of it. They take their share first and then give us what's left, us being we investors. So anytime you can shorten that gap, bridge that gap, minimize that gap, is a good thing for the American investor.
Yeah, you make a great point about cost, because people were not focused on that until you put it front and center with such low fees at Vanguard. And now you've got industry after industry trying to copy Vanguard, and whether it's the ETF industry, the index industry, or even just brokers trying to take their fees down. Is this a race to the bottom, Jack, in terms of how low fees have gone?
Well, that's really a great question, Maria, because most of the fee competition, in truth, is in the ETF, exchange-traded fund area, because that's where a lot of the activity is, that's where a lot of the cash flow is, and the competition is moderate for actively managed funds, and really very, very light for what I call traditional index funds, TEFs, index funds, TIFs, I should say, index funds of the type I started back in 1975 that are bought and held together and forever. And let me explain it this way. We've changed the business, the indexing business, from an passive index held by passive investors to passive indexes held by active investors. A lot of trading goes on in ETF land, and that's not such a good thing. So that's where the competition is, because you can make money starting a little company. I call them financial buccaneers, trying to find a little hole that nobody else has filled, a little niche, if you will. And there's not much appetite in the traditional index fund business for lower cost, because, as I say, I've often said, the problem with index funds is all the darn money goes to the investors. And the mutual fund business is a business that is, people come into the fund business to make money for themselves in their management companies. They want to make money for their investors, sure, but the more the management company takes, the less the investor makes.
And that's the issue, and a lot of people don't recognize that. That's why the first question is, how much is it costing you? Because it's the money is coming out of your returns. Jack, how do you answer the criticism, when I saw your interview with Barron's recently, about the critics of the index fund today, saying that you're not allocating capital properly? It's because the biggest stocks make up the biggest percentage of most of the indexes, like Microsoft is 3.2% of the S&P 500, while Walmart is 0.5%. 4%. So new money going into the index fund means that these already large stocks take a proportionally more money than other stocks. So is that destabilizing?
That's not only not destabilizing, Maria, it's not true. In other words, if we have 4% of assets in Alphabet or Google, we put 4% of our new money into that. If we have 0.5% in Walmart, as you said, we put 0.5% in our new money. It doesn't change the equation. We're investing based on the market values of the company. And when the prices of those companies go up, the prices go up in the regular market, if you will, by individual investors, but they also go up for the index fund.
Okay.
So rising prices creates zero capital allocation issues.